Are you outraged yet? The Biden administration just guaranteed over $150 billion in uninsured deposits from Silicon Valley Bank, bailing out wealthy tech executives and companies. This unprecedented move by the White House, Federal Reserve, and FDIC is a direct blow to regular working Americans and a clear signal of the government's encouragement of moral hazard and risk-taking in the financial system. In this explosive video, we'll dive deep into the details of this bailout and explain how it will affect you, the regular American. From the Fed printing money to the FDIC selling off assets, this is a crisis that you can't afford to ignore. So sit tight and get ready for a wake-up call that will shake you to your core. First, you need to understand what are uninsured deposits. This refers to the portion of a depositor's funds that are not protected by insurance. In the United States, the Federal Deposit Insurance Corporation, FDIC, provides insurance coverage for deposits up to $250,000 per depositor per insured bank. Any deposits above this limit are considered uninsured and are not guaranteed by the FDIC in the event of a bank failure. This means that if the bank fails, the depositor may lose some or all of their uninsured deposits. So, let's start by explaining how this bailout works. The Federal Reserve is promising to print money to make sure that all depositors of Silicon Valley Bank can take out all the money if they want to this week. But the FDIC is selling off all of Silicon Valley Bank's assets and using the proceeds to pay back the Federal Reserve. So in the short term, this might be a crisis averted, but we'll have to see what the markets do this week. Now here's the problem, folks. The reason there was a bank run to begin with at Silicon Valley Bank was because a lot of these tech companies started running out of money. And as we see the money supply continue to contract, other entities and stakeholders in the economy will begin running out of money and taking their money out of banks. Additionally, the reserve requirement for banks in America is still 0%, which means that the Federal Reserve is not requiring commercial banks to hold cash reserves. So long as banks continue to not be required to hold cash reserves, we're likely to see other bank runs and issues in the banking system going forward. You might be wondering why Janet Yellen is saying this is not a bailout. Yes, the deposits got bailed out, but the people who own stock in Silicon Valley Bank and some unsecured credit holders will not be getting bailed out. So some people will be losing their money in full out of this, which is good, as the U.S. government is not socializing all of these losses. However, they're setting a very bad precedent for banks and encouraging moral hazard and risk-taking in the financial system with no repercussions. So, what does this mean for you as the regular American? Well, the Federal Reserve is printing money to cover the withdrawals from Silicon Valley Bank, and this might lead to inflation or potentially deflation. But we need to keep an eye on the Federal Reserve balance sheet, specifically the total assets held at the Fed. If we see these assets start to go up, it would be a signal of more money printing and more inflation. When the Federal Reserve prints money to cover the withdrawals from Silicon Valley Bank, it increases the money supply in the economy. If the increase in money supply outpaces the growth in the economy, it can lead to inflation, as the increased money supply will bid up the prices of goods and services, making it more difficult for average Americans to make ends meet. On the other hand, if the increase in money supply is not enough to keep up with the contraction in the economy, it can lead to deflation, as the decreased demand for goods and services will lead to lower prices. Therefore, it's important to keep an eye on the Federal Reserve balance sheet, specifically the total assets held at the Fed. The bailout of Silicon Valley Bank has the potential to impact the U.S. economy in a number of ways. First, it sets a dangerous precedent for other banks in the future, who may feel encouraged to take on more risk, knowing that the government will bail them out if things go wrong. This could lead to increased instability in the banking system and greater risk to the financial system as a whole. This could have a negative impact on the U.S. fiscal position. The U.S. government is already facing a large budget deficit, and the bailout of Silicon Valley Bank will likely add to that deficit. This could lead to higher taxes in the future or cuts to government programs, which would have a negative impact on the average American. If people see that the government is willing to bail out wealthy tech executives and tech companies, they may lose confidence in the stability of the banking system and start to withdraw their money from banks. This could lead to a run on banks and a financial crisis, which would have far-reaching consequences for the U.S. economy. So, what should you be watching for in the coming weeks and months to see if this bailout will have a negative impact on the U.S. economy? Here are a few things to keep an eye on. 1. Inflation rate. If the inflation rate spikes, it could be a sign that the bailout is leading to increased money printing and inflation. 2. Interest rates. If interest rates rise, it could make it more expensive for people to borrow money, which could have a negative impact on the economy. 3. Federal Reserve balance sheet. Keep an eye on the Federal Reserve balance sheet to see if the assets held by the Fed are increasing. If they are, it could be a sign that the Fed is printing more money to cover the bailout of Silicon Valley Bank. 4. U.S. budget deficit. Keep an eye on the U.S. budget deficit to see if it is increasing as a result of the bailout. If it is, it could lead to higher taxes or cuts to government programs in the future. 5. Confidence in the banking system. Finally, keep an eye on people's confidence in the banking system. If people start to withdraw their money from banks, it could lead to a run on banks and a financial crisis. In the past, bank bailouts have been seen as a way for the government to protect depositors and prevent a financial crisis. However, they have also been criticized for creating moral hazard, where banks are encouraged to take on more risk, knowing that the government will bail them out if things go wrong. One of the most famous bank bailouts in U.S. history was the bailout of the savings and loan industry in the 1980s and 1990s. This bailout cost taxpayers billions of dollars and was widely criticized as a way for the government to protect wealthy depositors and institutions at the expense of the average American. Another famous bank bailout was the Troubled Asset Relief Program, TARP, during the 2008 financial crisis. This bailout was designed to stabilize the U.S. financial system and prevent a widespread collapse of the banking system. While it was successful in preventing a financial crisis, it was also widely criticized for bailing out large financial institutions at the expense of the average American. The bailout of Silicon Valley Bank is a direct hit to the pockets of regular working Americans. By guaranteeing over $150 billion in uninsured deposits, the Federal Reserve and FDIC are making sure that wealthy tech executives and companies can keep doing business, while the average American bears the consequences of higher inflation. The increase in money supply due to the Fed printing money will bid up the prices of goods and services, leading to higher inflation. This will reduce the purchasing power of the average American's hard-earned money, making it more difficult for them to afford the basic necessities of life. Furthermore, this bailout sends a clear message that the government is willing to bail out the wealthy at the expense of the average American. By removing the consequences for risky behavior, the government is encouraging moral hazard and risk-taking in the financial system. This means that in the future, companies may be more likely to make risky decisions, knowing that the government will step in to bail them out if things go wrong. This bailout is a clear injustice to the average American who works hard every day to make ends meet. The Fed and FDIC should be held accountable for their actions and the impact they have on the lives of regular working Americans. It's time for the government to prioritize the well-being of the average American and ensure that they are protected from the consequences of these bailouts. In conclusion, the bailout of Silicon Valley Bank highlights the importance of financial planning and investment strategy. It's important for regular working Americans to take control of their financial future and not solely rely on the government or banks to secure their hard-earned money. With the increasing supply of money due to the Fed printing money, it's more important than ever to consider alternative investment options to protect your wealth from the consequences of inflation. There are many strategies for investing your money and building wealth, including stocks, bonds, real estate, and alternative investments like cryptocurrency. By taking the time to educate yourself and diversify your investments, you can ensure that your money is working for you and growing over time. The key is to have a strategic approach to your finances and be proactive in securing your financial future. Don't be passive when it comes to your finances. Take control and start building the financial future you deserve.